name is Queston with Good Fortune Financial, and I'm a licensed insurance broker, and I write for probably 20 plus of the premium carriers that's out there in the United States as well. So what I'm going to do is I'm going to break down what is an IUL, or wealth protection standpoint, life insurance, living benefits, cash value, and legacy, and we're going to try to do it real fast. I want it to be a crash course, but I also want you to be able to absorb it as well. So stick here with me. We're going to get through this thing as fast as possible. Let's go. So this what we'll cover today. We'll cover the actual product, the money, the access, and what is an IUL. An IUL is an index universal life insurance policy that is a permanent life insurance policy that's designed to combine protection with potential cash value to accumulate cash value. Okay, it has cash value in it and accumulate cash value as well. So life insurance protection, number one, cash value, and number three is the index linking, usually with the S&P 500. Number four is the living benefit as well. And this is a raw video of recording this live, so if you see it and there's any mess ups, hey, it's live. So protection across a lifetime. An IUL is simply not about what happens when you pass away. It can potentially provide protection while you are living and while your money is still accumulating after you're gone as well. It will protect you. So how an index interest work, right? It's a positive index year. Crediting depends on the policy. It's the participation rate, it's the cap, it's the spread, and it's also the credit monitoring method and other provisions as well. So this is the zero floor, which a lot of insurance carriers use. Many index strategies apply the zero index crediting floor in a negative year, but zero credit doesn't mean that the policy cannot lose value from the perspective of insurance costs, admin expenses, and rider charges as well. But it don't lose the value. The premium stays the same. All right, so this is just a crediting example. The index fall 15% in the market. S&P 500 to fall 15% with the 0% flooring. The index credit may be zero rather than the minus 15%, and the policy changes are still deducted, and it's usually from like the premiums and so on and so forth, or some of the cash value that you may have built up in that policy throughout the year. And the index raised sharply, so the policy does not necessarily receive the full return. You have caps, participation rates, and crediting formulas that also applies. So that's why an IUL should never be presented as guaranteed of like 8%, 10%, 12%. Although most IUL policies, they come in at a rate of about 8 to 12% a year as well. So, excuse me. So, where does my premiums go? Everybody want to know where their premiums go, right? So your premiums does not simply go into a savings account. You still have, expenses and things like that that come along with the policy. So the cost of insurance, policy expenses, your riders, the cash value, what remains can accumulate and fix in the index strategy as well. All right. So why does the policy design matters? Two people with the same death benefit can see very different cash value results, and it's all based on the age, health, risk classification, death benefits, premium, funding, riders, indexing, withdrawals, loans, and original structure as well. So the tax advantages. Cash value generally grows tax deferred while it remains inside of the policy, and value may be accessible through withdrawals and loans on a potential tax advantage basis. It's not automatically tax free, but if it's inside of the policy, you can treat it as such, and it depends on the factor of the MEC status as well, and whether the policy stays enforced, and the clients can consult with a qualified tax professional, and I'm a tax professional as well. All right, so let's go with the withdrawals versus the policy loan, right? So option one is the withdrawal. Everybody want to seek this. So it permanently removes the money from the actual policy. It reduces, but what happened with this is it reduces the available cash value. It may reduce the actual death benefit, and it affects the policy performance. and it may have tax consequences as well. Then we go over here to option two. Option two is just a policy loan. A lot of people do this in order for them to start businesses. We're talking about borrow against the policy value instead of withdrawing it. The carriers lend against the policy. The interest is charged per contract. Loans can be reduced. Loans can reduce the policy benefit as well. All right. So to become your own bank strategy that people use, what I just explained to you about how you can borrow from the system, that is the basis of the build your own bank situation. So I know we see a lot of things that's online that say, well, yeah, you can go ahead and build you, but that insurance money is literally also coming from the insurance company. That loan is coming from the insurance company. Although you do own the policy, it's still under the premises of the actual insurance company, but you can build your own bank with this policy. All right. So what can cash value be used for? This is a big topic that we need to discuss. It can be used for business capital, equipment, marketing, expansion, and inventory, retirement income, part of broader retirement strategy, emergency funds, unexpected financial crisis, education, college tuition, and other educational costs. In real estate, it can also be used to have a down payment on your home or an investment opportunity. Major purchases like a vehicle, property, and major needs as well. So the death benefit. Let's talk about the death benefit portion of it. Primary purpose of the IUL is still life insurance. So death benefits are generally received income tax-free by the beneficiary under the current federal tax laws. So mortgage payoff, income replacement, child education, business obligations, estate expenses, and generational wealth can come along with the death benefit, and that is a good thing about this IUL policy. So the living benefits. Certain modern policies can provide qualifying and accelerated death benefits while the insured is still living as well. So terminal illnesses, right? Chronic illnesses, critical illnesses. So certain riders can cover specific qualifying medical conditions, and it may also apply to for activities in daily living. Cognitive impairment that is triggered, based on qualifying terminal illnesses, is based on qualifying life expectancy and determination when you can get access to that policy. So you have a $500,000 policy with an accelerated benefit rider, right? After the qualifying medical event that transpired, it could potentially accelerate a portion of that debt benefit while you're alive to handle your mortgage, your household expenses, your medical related costs, replacing lost income, transportation, family expenses as well. This amount is available to determine which carrier that you may have under their rider, and it may be less, and the amount accelerated and reduced remaining on the death benefit. So it determines with all of those factors as well. So why does maturity matter, right? Maturity is big with an IUL, and you don't want to be too halty when you're inside of an IUL, because the contractual age at which the policy matures, often around the age of 120 to 121, it does not mean that the money becomes available in 1 to 3 years, right? But you can access the money based on the carrier's policies and when they say you can access the money and when they say you can't access the money. All IULs are different, so you got to consult with your insurance professional so they can break down exactly what that carrier states when you're talking about the maturity age. So it's completely different from the cash value accumulation, the loan and withdrawal availability, the surrender period, the no lapse guarantee period, and the right of way period. So it's different from that. So when we're talking about the maturity age, it's different from these factors right here. You still can get the cash value accumulation, the loan withdrawals, the surrender periods. You can do all of this stuff right there. The maturity age is just different. So I just had to mention that. All right, so why the first few years matter. So an IUL is a long-term financial product, not a short-term savings account. Early years can include substantial insurance costs, premium charges, and administrative expenses and surrender charges, right? The objective is a long-term protection. When you properly design it and you fund it long-term, it builds that cash value that you need that can be substantial in the time of an emergency. So, overfunding and the MEC limits. We have to understand what the MEC limits is as well. So, MEC is a modified endowment contract. So, fund too aggressively and the policy can become an MEC, and it's still a life insurance, but distribution and loans can receive different tax treatments. So you have to obey the MEC, right? Because you don't want it to turn into a situation where they looking at the situation as a tax haven. So we're gonna avoid that. So we have to understand that accumulation focused design paired with properly structured death benefits with higher premium funding while staying in the applicable tax laws. So you don't want to go to the extreme. All right, so the three brackets of explanation. So we have number one, the protection, the life insurance and death benefit protection for the people you love. We have number two, the living benefits, the qualifying accelerated benefits as well for certain serious health events. And number three, we have the cash value, which everybody loves the cash value that comes along with it. We talk about the potential long-term accumulation that may give you access during your lifetime. So we have protection, living benefits, and cash value. All right, IUL versus high yielding savings. So a savings account is designated for liquidity and savings. Interest is generally taxable when it is earned, no insurance costs, right? An IUL is an insurance contract that may accumulate cash value via tax deferred and with insurance costs and policy expenses. So that's the difference between the two. So the IUL versus the direct market investment. And direct market investing as well. IUL does not invest policy values directly into the S&P 500 or another index. The index is part of a crediting formula, right? So it doesn't actually invest the money inside of the market, but they do usually mirror the S&P 500. It is a crediting system that is in place with that. So the downside, a floor may protect against negative index crediting. The upside is limited by the cap, participation rates, the spread, and other provisions as well. So this is questions every client might ask, what is my guaranteed death benefit? What is my premiums? What happens only if I pay the plan premiums? What happens under the lower crediting assumptions? They might ask, what are some of the policy changes? How long do the surrender charges apply? When can I access my cash value? What is the current guaranteed interest rate? They asked all of those questions. So the question, right? What living benefits are included and exactly what a condition qualifies? What happens when a death benefit is accelerated? What happens when a large policy loan is taken out? Could the policy lapse and loans be outstanding? Could this policy become an MEC? Most importantly, right, you got to show the illustration. It provides quality within this policy and projection that guarantees that rather than a generic answer, right? So, the good fortune philosophy is protection, access, accumulation, and legacy. That's what it's built upon. So the age, health, family income, the budgeting tools as well, the goals and the tolerances and time horizon. That is the policy of Good Fortune Benefits Group. So I'm glad that you guys are here to, get a greater understanding of what an IUL is and how we can take it to the next level with an IUL. But these are some important disclosures, right? I want you guys to overlook that and understand from an educational standpoint. I will be giving information out on what IULs is. I will do this weekly, but it was a pleasure to have you guys here with me. And I appreciate you guys coming out, checking out this video. Like, share, subscribe. Do whatever you got to do. Contact me. My info will be down there if you need a policy. And we can get on the call and discuss what we can do for your future. Thank you. Peace.